International investing. I know it sounds flashy. It is a very cool thing to say and do, but purely from a investment logic, from a financial prudence standpoint, investment prudence standpoint, why should you do it?
See, typically our portfolios have home bias. Okay, they are biased
Right.
towards the home market.
Yeah.
Okay, you understand those companies, you see those brands, you use their products. Okay, you live here. Most importantly.
Yeah.
Okay, you buy assets there. You're planning to spend your life in India.
Right.
So your portfolio should be concentrated in India only, on India story only.
Right.
Okay. If inflation is high, it will impact your living standard. Inflation, there is a recession, it will impact your living standard.
Right.
Okay? So a portfolio should reflect that reality. Okay. But it is also true that a portfolio that is concentrated on local market expose you to economic and geopolitical risk associated with that particular market. Okay, let me give you one example.
Yeah.
Like in 2004 elections, okay, NDA lost the election, 2004 general elections,
Right.
unexpectedly.
Okay.
Okay, so entire market was rooting for comeback of NDA government in the power. Okay, so there were two lower circuits after the next day after the result. Okay, and Nifty was pulled into bear market.
Okay.
And that bear market, where Nifty recovered after 6 months from that bear market and made a new high. So elections were in May and new high was made in around October near Diwali.
Okay.
Okay. So it was a India-centric bear market. It had to do with political risk associated with India.
Yeah.
Okay.
Right.
Associated with India. During the same time, S&P provided nearly 10% returns, S&P 500. So if you have some diversification toward S&P during that time, you could have protected yourself against some losses.
Right.
Okay.
Right.
So that's the home market bias introduce a political and currency risk. Okay, that can be diversified through international exposure. So if you have to name a single biggest factor in a particular economy or a particular country, for a particular country, it's its currency.
Yes.
Okay. So there is a significant currency risk that is associated with investments in financial market.
Okay.
International exposure give you opportunity to diversify that particular currency risk.
Right.
Okay. Like India was one of the worst performing currency during from 2001 to 13. Okay. There was a depreciation of nearly 50%. At that time. Okay. The market returns were quite stagnant. There was nearly 20% losses during that period. Okay. And but if you look at the S&P 500 during the same phase, okay, from 2000, let's say 2010 end to 13 end, okay, there were losses of around 20% that time. But in S&P 500, if you see, there were gains of 50%. Okay. Wow. But if you add currency depreciation angle, okay, those gains would become 100%.
Okay.
So that's how geographical diversification can help you, okay, mitigate the risk, macroeconomic risk associated with Indian market.